Investment contract. Please check this. Obligation to go public clause. Effort is important. Investment contracts often contain clauses stating that the company must go public within a certain period, or must go public unconditionally if the listing requirements are met. However, this can become a significant burden or a source of dispute for startups later on. Going public isn't just about meeting requirements. External factors like market conditions and public offering prices are also crucial. Sometimes, not going public might even be better for the company. Therefore, it's highly recommended to revise such obligatory listing wording to be more lenient, like, endeavor to go public within a feasible timeframe. This helps reduce unnecessary risks later on. Scope of damages. Setting a limit provides peace of mind. Almost all investment contracts include clauses requiring compensation for damages in case of violation of representations and warranties or breach of obligations. However, if the scope of these damages is too broadly defined, it could lead to an unbearable amount of liability later on. Therefore, from the major shareholder's perspective, clearly defining the limit of damages is extremely important. If it's difficult to set a limit for every item, it's advisable to set limits for at least areas like taxes or contingent liabilities. This allows for predictable risk management, right? Investors' right to intervene in management protect our company's autonomy. Since investors have invested in the company, they often have rights of consent or consultation regarding important management matters. While this is natural, if it's too excessive, it can hinder a startup's quick decision-making and autonomous management. Even for director nomination rights, it's good to limit them too. When the investor maintains a certain percentage of shares, for important contracts or loan consent matters, it's better if they only apply above a certain amount. And for sensitive areas like significant executive salary increases, you should strive to make them consultation matters rather than consent matters. This allows our company to operate flexibly. Right of first refusal and prohibition of sale to competitors. Build a strong shield. When an investor sells their shares later, it's good to include a right of first refusal clause, allowing our company's major shareholders to buy those shares first. If the major shareholders lack funds, it's even better if a third party designated by them can also exercise this right of first refusal. And what's truly important is to definitely include a clause preventing the investor from selling shares to our company's competitors. If a competitor acquires shares in our company, it could lead to management interference and even the leakage of important company secrets. This is truly an absolutely essential clause. Loss of management intervention clause. Effectiveness upon shareholding. Decreased shares and rights should go together. What if an investor keeps selling shares and their shareholding percentage becomes very low? If their stake is minimal, but clauses allowing management intervention are still active, it would be really disadvantageous for the major shareholders, wouldn't it? Therefore, it's wise to stipulate that if an investor holds less than a certain percentage of shares, the management intervention-related clauses automatically lose their effect. It's reasonable for rights to adjust according to shareholding. Summary. Review thoroughly with experts. Investment contracts are truly complex and contain many difficult provisions. In addition to the key clauses I've mentioned today, there might be poison pill clauses hidden that are unfavorable to startups. Therefore, rather than blindly signing the contract proposed by the investor, it's crucial to seek legal expert assistance to meticulously review the details in advance. This prior review is absolutely essential to maintain a harmonious relationship with the investor, who will become a strong shareholder of our company in the future. Fighting.